Elon Musk and Jeff Bezos. The two richest people on the planet own less than 13% of their respective companies. If you're building a business today, what are you building it for? Where are you headed to? And at what point are you going to monetize it? When's the time to sell my business? Most of the entrepreneurs that I work with are in their 40s or 50s or 60s, and they have a really high disproportionate amount of their net worth tied up in their business. And as they're getting older, they're just assuming way too much risk. Most entrepreneurs think of exiting a business as a one and done event. I like to call it's the first rest stop on the wealth creation highway. You want to generate true wealth for your family, at some point you have to monetize the asset.
How can private equity fuel your exit strategy? What's the secret to creating generational wealth? And how do smart founders plan for the perfect exit? Hey everybody, and welcome to Mission Daily. I'm your host, Stephanie Postles, and joining me today to answer all of those questions and more is Adam Coffey. Adam is a seasoned business leader, an author, and a consultant known for his expertise in the private equity industry. He's the founder of the CEO Advisory Guru and the author of 3 #1 bestsellers, which include The Private Equity Playbook, The Exit Strategy Playbook, and Empire Builder. Over the past 20 years, he's managed $2.5 billion in successful exits. Today, we're going to dive into the world of private equity, discuss exit strategies, and what it takes to build generational wealth that lasts. Adam, welcome to Mission Daily.
Well, Stephanie, it's good to be here. Hello to all your listeners out there. I'm pumped. Let's do this.
Yeah, I'm so excited. I've been looking forward to this conversation. I know my team has. They have read a lot of your books. And so you're kind of like a celebrity within my company. And so I want to start with your background. Like, what gave you this status? You've been in private equity a long time. You're definitely a thought leader. You've had a lot of exits. I'd love to hear about your journey.
You know, I think for all of us, life is just this collection of just individual adventures and journeys. And I've had a lot of little sub-lives in my, over the course of my career and my life. I just recently turned 60. If I go back and I think about what got me here, I'm a veteran U.S. Army. Military taught me something about discipline, teamwork, leadership. And it's the military that actually brought me to Texas for the first time, way back when in the Stone Ages. I then had another career as an engineer. Engineering made me a meticulous planner. I'm a pilot. Pilots don't take off unless we know where we're going, and then we deconstruct the trip. Very useful skill later on in the world of private equity. I then went to General Electric. This is before tech existed. Jack Welch is the world's most admired CEO. He's at the helm. GE's #1 on the Fortune 500 list. Company's growing so fast, it's doubling in size just literally every 2.8 years. And wonderful time for kind of young Adam to learn how to run a business, under the tutelage of the world's most admired CEO and the world's largest company. And so spent 10 years at GE. And then that brought me to 21 years as a CEO, building 3 large companies for 9 different private equity firms. I was a turnaround guy at GE. Every one of the companies I ran had been in business for like 40 years before I got there. They were not delighting. They were turnarounds. There was stuff going on. And so fixing them and then getting them to grow at a pace that they had never grown before, and then selling them multiple times. And so I fortunate buy and build guy. I bought 58 companies during that run, and assembled them into 3 large companies and, $2.5 billion in exits as a CEO. And I completely got bored. I don't mind telling you, I was just bored building one company at a time for a bunch of institutional shareholders. And I'm like, this isn't fun. I had been teaching for 15 years at the university level in an executive MBA program. And that kind of got me writing books, and I was enjoying the giving back part. Wasn't enjoying kind of the tactical crap that goes with running a company day to day. And so I made a conscious decision to hang up my CEO cleats, start a consulting business. And I said, for the last 10 years of my career, I am going to teach entrepreneurs like your listeners out there how to be successful in building, scaling, and exiting their businesses. So today I work with about 15 private equity firms. I do what's called operating partner work. I coach and mentor CEOs. I sit on boards. I'm working with 71 founder-led companies right now, which is a whole lot of fun.
Wow.
and I have many different industries, and I'm helping these entrepreneurs learn how to scale, maximize potential, and prepare for exit. I've already had over $500 million in exits of my clients, who have already transitioned, call it, and sold their businesses. And so having a bunch of fun, which is good. I work more hours than I did as a CEO, which I didn't think was humanly possible, but that's my wheelhouse today. So,
Wow.
hopefully it's the right audience out there that's going to enjoy this.
This is definitely the right audience. I mean, I love to like the transition to the more how do I help the entrepreneur space, and that you have like a viewpoint into both sides. I mean, you're working with the PE companies and you're working with the founders, so it seems like a really strategic
Because when
benefit.
I work with PE, with buyers, I am helping them identify risk
Mhm.
and helping them decide when to walk away and how to price risk. When I'm working with founders, I'm on the other side of the table and I'm helping them identify and eliminate risk. So when guys like me are looking under the hood, they don't find it. And that
Mhm.
causes them to pay up. And so on one side of the table, I'm eliminating risk. The other side, I'm identifying risk. But in investing, it's all about risk.
Yep, yep. So I want to start with definitions. First, just private equity. What is it? What are some misnomers about it? Like, what do people think it is versus what it actually is?
But you and I were talking about this off camera, and I'll tell you that to this day, I teach seminars globally. And if you put 1,000 business owners in a room from all around the planet, and these are people who are successful and they think that they have a good working understanding of private equity, what it is. I'll give them a basic 10 question multiple choice quiz to start the seminar. And 90% of the people in that room fail miserably a multiple choice basic 10 question quiz. And so it really just drives home the point that people out there really don't understand, and they need to understand. Private equity in the 21 plus years I was a CEO grew from 800 billion in assets under management to today more than $7 trillion. Private equity is literally buying more than 50% of all companies bought and sold on the planet. You cannot get through a 24-hour day without seeing a logo of a company that's owned and backed by private equity. You can't even go camping by yourself to Denali National Park, and not encounter private equity, because half your camping gear is going to be owned by companies that are backed by private equity. It's like it has created the market by which entrepreneurs can actually sell their businesses and make a ton of money. And so, in basic layman's terms, a typical private equity fund aggregates money from a bunch of investors. Usually about $5 million is the smallest size of investment. It's coming from university endowments, public pension funds, very wealthy investors, and family offices. There's no liquidity for 10 years, so we're committing capital for a very long time. All funds, on average, last for 10 years. They have 6 years to invest their capital. So unlike a mutual fund where you would buy your shares up front, you commit capital to private equity. And for the first 6 years of the fund's life, they can call capital from you when they're going to make an investment. Well, why do they do that? Because if they take your money on day one and they have nothing to buy, then they
Mhm.
have to start calculating the return on your investment from the day they take your money. So they purposely delay when the clock starts ticking, and they have 6 years to deploy the capital that you've committed. So you've got 6 years as a PE firm to buy stuff, and then typical hold period's about 5 years. And then by the end of the fund's life, we have to sell all of our assets, all the companies, and we have to return all the money back to our investors. And so that's kind of the realm of private equity. It's like a mutual fund, but private, no liquidity, large minimum investment sizes, 6 years to invest, 5 year hold period, sell by the end. This is the machine and the thing that's gone from about 800 billion in assets under management to more than 7 trillion just in the last few decades. And the reason it's grown so fast is because on average, it is returning more than twice the S&P 500 or the MSCI World Index. And so investors keep looking for alternative type investments that beat the market. The world of private equity continues to do almost double the market. And so it's still attracting investors. Thousands and thousands of new firms are being created, new funds are being raised, and the size of investment just keeps on increasing. And so we're now looking at a $7 trillion industry that buys half the companies sold on the planet.
Half. I mean, that's wild. Okay, so, I'm a founder. So if I'm hearing this right now, what kind of companies do these PE companies look for? Like, I'm trying to think, like, which ones are a good fit? What is the revenue? What kind of industries are they looking for? Like, who's a fit and who's not?
Well, it's really all industries. And so there are some requirements that private equity tends to focus on and tends to have. So there's, first of all, virtually every sector of the economy has PE activity. So you're down in Austin, you're at Tech Central, in Texas here. We're the new Silicon Valley, and so there's a lot of tech investments going on. And you have some very large PE funds in Texas. And my son is a CTO of a private equity backed company that's owned by Tomo Bravo, and so PE is active in every sector. You can't find a sector that PE is not active in, but there are some things that they generally are looking for. We're looking for fragmented industries. So what does that mean? Well, like right now, I'm doing 3 roll-ups in the accounting world, accounting, bookkeeping, payroll services type companies. There's 1.8 million accounting, bookkeeping, payroll services type companies in the United States. That's a whole lot. And they're small, relatively speaking, on average. And so fragmentation keeps the purchase prices low. So the cost to enter to buy small companies and aggregate them, so I need fragmentation. Let me just give you one example. So the last company that I built was in the HVAC, HVAC and refrigeration services type space. I bought 23 companies in 5 years. And these companies on average sold for about 5 times. They had about $2 million in earnings. So they're small companies, relatively speaking, in the world of PE. And they're trading for low multiples because there's plentiful. There's not enough buyers to buy them all. Prices are small. And this follows some government statistics. There's 34 million small companies in the United States, just in our country. But there's only 3,000 companies on the entire planet that have $1 billion in revenue. So small companies trade for small multiples, but as companies get bigger, they trade for higher multiples. One of the biggest ways private equity makes money is by coming into a fragmented industry, buying and aggregating small companies that trade for small values, buying good companies, paying fair market value, putting them together, climbing up above the world of the 34 million small companies and creating something that's rare. And because there's fewer companies at a larger size, they tend to trade for higher multiples. And so multiple arbitrage, or the difference between the price I pay to buy a small company and collect them versus the price I pay to sell a large company. So my last company, I was buying companies on average for 5 times. When I sold for 14 times. So every dollar of earnings that I was buying and paying $5 for, I'm now selling that dollar of earnings for 14. And so that's $9 of profit that comes from building something bigger, something that's rare. And so this is the kind of basic construct. So PE likes to first they find a platform company, it's called. So this is a little bit bigger company. I'll call it, there's enough clay on the potter's wheel to where it's got infrastructure and it's got things that I can now bolt small companies onto. And then I'll go out and buy a bunch of smaller companies and add it to my platform, build something big, and then roughly over a 5-year period, I'll integrate it, I'll improve the margins, I'll build the culture, and then I'll sell it. And then PE firm needs to sell because their time period's running out, on their fund. Next PE firm that's larger swoops in, buys it, they take it for the next 5 years. You can do this 5 times on your journey from startup to essentially public company, exit, call it. Mm-hmm. And so natural occurring arbitrage is the largest, or multiple expansion is the largest way that PE firms are making money. But truly understanding as an entrepreneur how this works is very helpful. Typical PE firm that's looking for a platform is looking for something that has about 4 million in earnings. And so depending on the industry and what the margin profile is, this could be a company that's got 8 million in revenue. It could be a company that's got 15 million in revenue, but around 4 million in size is where the first echelon of real traditional private equity is coming in looking to buy platforms. And they'll take it from about 4 million in earnings up to about 15. So what does that mean for smaller companies who are below that level? Do I not have a private equity potential? No, you still do. There are smaller PE firms that are a little bit less traditional. Might be some folks that did really well working at a big PE firm, made a bunch of money. They rolled out, they created their own little firm. And they specialize in stuff that I'll call it's from like 1 million of EBITDA or 1 million in earnings up to about 4 million. Generally, when I'm working with clients, though, I tell them, look, if your earnings are below 4 million, you have a choice to make. I can either be a really small platform for a really small PE firm, or I potentially could be an add-on investment, one of those companies I'm buying and collecting and putting together with a much larger firm than the one that I've got that is serving as the platform. And there's pros and cons to doing either path, but there's always a buyer for any size business, virtually in any industry, as long as it's a fragmented industry where there's a lot of companies, there's a large total addressable market. And the reason this stuff matters is because PE just has a very short window to work with a company, and organic growth is best. And a company needs to have good, strong organic growth and improve operating margins. But the problem is PE doesn't have time. And so if it's a growth, a company that's growing at 10% a year organically, then the law of 72 applies in investing, which means if I'm growing at 10% and I'm $1 million company, in 7 years, I become a $2 million company. In 14 years, I become a $4 million company. And in 21 years, I become an $8 million company. And that's just too slow. So most private equity returns are generated by a combination of strong organic growth plus mergers and acquisition. And it's the combination of these types of investments being available that make an industry attractive to private equity.
Yep.
That was a long answer to a short question. Sorry about that.
It's a very good explainer because I think it is a space that most people don't understand. So if I'm thinking about like entrepreneurs, how do you think about buying businesses? Or if someone comes to you and they're like, I have a company and it's got $1 million, 2 million, 3 million per year. And maybe like it's a startup. And I'm asking this because I started my company in the Bay Area. And so a lot of the things that you're talking about, I can just imagine the founders there being like, oh, PE, definitely not. I don't want all my equity taken away. Look what happened to Mark Zuckerberg, or maybe some of the founders out there who just don't have any, like they really care about
poor
that.
Mark, he's only one of the richest guys in the world.
I know, right?
Yeah.
How do you think about the buying, like, because I know you like needs businesses, like HVAC, plumbing, pest control, things like that. How do you think about guiding someone on this is a very good opportunity versus a new company? For my young tech entrepreneurs out there, a lot of times we think we have to create the newest thing. We're trying in our minds to create the new best thing. And of course, right now with AI just being so explosive, and truly will change the world. Everybody in the world is like, how can I start some kind of new tech, AI thing? And so there is so much risk in startups. So let's just look at the math. Let's look at the numbers. 34 million small companies in the United States today, 34 million. And of those 34 million, only 7% ever get to $1 million in revenue. And of those, only 40% are profitable. 30% are losing money, 30% are break even, and only 7% of 34 million ever get to $1 million in revenue. And only 4% of those ever get to 10 million in revenue. And 65% of them will be gone in 5 years because they'll fail. And there's only 3,000 companies on the entire planet with $1 billion in revenue. And so success is a really elusive thing
when you are a startup. And I don't mean to burst anybody's bubble out there, but when I think of venture capital and I think of the type of investing that they do, so many of my friends will come to me and say, "Hey, Adam, I've got a chance to become an investor in this venture capital fund. I'm so excited. I'm going to bet the farm and, look at it for me and look at this prospectus, look at this, booklet and tell me what you think." And I look at that, I have yet to look at a venture capital fund that beats the S&P 500, with historical numbers. They just don't. There's a time and a place for everything. Everybody wants the next home run. Problem is venture capital has a very low win rate. The reason it has a very low win rate is because failure rates are so high in the startup world. Doesn't mean you can't make money. You can make money anywhere. But I like to stack the deck in the favor, from an odds perspective. I want you to win. I want the people listening out there to win. And so when I think about retiring baby boomers and the largest wealth transfer in human history of millions of companies that need to be sold, I can actually beat the odds by buying a business that already exists, that has a history of revenue, a history of earnings, a history of satisfying some customers' needs. I can study its historical financials and I can look and see what happened during the pandemic or during a recession or this period of high interest rates. And so I can look at it and analyze how it survived across multiple economic cycles. And I can completely eliminate startup risk by buying an existing company. And so then I think about, well, what kind of companies? Well, I am a services person. And so, as you pointed out, I like to find companies that aren't very sexy, but they're needs-based, not discretionary. And so it's like, if I think about needs versus wants, I'm sitting in my beautiful new office building, right? If it's raining outside here in Texas, which once in a blue moon it does, and when it rains really hard. If it was leaking and dropping on my head, I need my roof fixed. I don't have a choice, and maybe I go up there and kill myself and use some Flex Seal and try to patch it up. But, at some level, I have basic needs. You know what? If my tooth hurts, I got a need, remember Tom Hanks in the movie Castaway where he broke his own tooth out, when he's stranded on the island. It's like, I either got to do that or I got to go to a dentist. I mean, there are certain things in life that we just need. I'm going out to dinner Friday night. It was my wife's birthday. We're going to this place in Dallas, which is 49 floors up and beautiful views. She wants a new outfit to wear to that dinner. Well, if I'm broke, if I'm unemployed, if the economy sucks, then what she wants versus what she needs are two different things, hon. Go to the closet. There's a ton of dresses in there. We can't afford a dress, right? So it's like I've got needs versus wants. When the economy cycles down, companies that are based on wants tend to cycle down and suffer greater declines in revenue and earnings. And so I can think about needs versus wants. Then I can focus on recurrent revenue versus project-based revenue. So first, I want all your listeners to know you can make money in any industry that does anything. But the world of our economy moves in cycles. We've got periods of expansion, peaks, troughs, and recessions. And so the economy moves in cycles. If I can buy a business that's insulated from economic cycle differences, that's a needs-based versus wants-based, I'm going to be more stable. And then if I can focus on companies that have contracted revenue versus project-based revenue. So you mentioned pest control. Great example. Not a very sexy industry, but if you live here in Texas, we've got bugs that you can put saddles on. And my wife says, I don't want that stuff in the house. And so I actually have contracts with 2 pest control companies that come different times and spray the outside of my house. And I have a contract. They have my credit card and they bill me every month. I don't see it. I don't even pay attention to it, and then it's like, hey, Adam, we got mosquitoes, in the summertime, and, hey, we can do it's another contract different. Should I use the same credit card you've got on file? Yeah, sure. Go ahead. I don't want mosquitoes in my backyard when I'm having a pool party, and so we do that. And then it's like, hey, Adam, we got termites, that's a separate contract though. Yeah, go ahead. Use my credit card. And hey, Adam, we got army worms that'll eat your grass, from the roots, and in a few weeks your grass goes dead, and it's like, well, we can spray for that. Yeah, okay, go ahead. Like, before you know it, they're hitting my credit card like 5 times a month, and they're coming once a quarter to spray different stuff. I'm not paying attention. A pest control contract, once it's put in place, never gets shopped. And it probably lasts until 5 months after I sell my house and finally realize I'm paying for pest control for somebody else because I don't even live there anymore. And so that is what I call bulletproof contracted revenue. It's a needs-based business, not a want. And so it's going to create very predictable revenue streams. Think about that versus, I talked about roof as an example. Well, the problem with roofs is that it's project-based. Adam only needs one roof, about every 15 years. And so whatever your revenue was this month is me. Well, next month, I don't need another new roof. You start at zero. To get back to where you were, you got to find another me, and once you get another me, now you're back to where you were. And so project-based revenue can create vacillations or variations in revenue streams. And if I'm buying a business, I want to use the cash flow in the business to service the loans. So if it's a need, it's stable. If it's a recurrent revenue business, it's stable. And I can count on the cash flow in those businesses to service the debt that's required to buy it. I can substitute a seller that's leaving's income. I could step into the business as a small entrepreneur and I could assume that revenue is my income now, and I could continue to run that business, and it has a history and a stability about it. And so I completely beat the odds of a startup. And so I tell a lot of people, it's like, there's nothing wrong with being a startup person, but as you would know, bootstrappers tend to be under-resourced. And if I come in with a skill set to work, at this new tech company startup, I don't have healthcare. I don't have any of this stuff. I'm working for pennies, all on the hope of the come that something great's going to happen. Meanwhile, I could buy a business that's not sexy, that's boring. I could step into it, create a very high income right off the bat, and build it into something that I could sell for millions. And so I just find it to be a little bit more efficient to do a buy versus a build, bootstrap, startup from scratch. And that may get some people thinking differently out there. I'm not sure. But again, baby boomers are retiring. Millions of businesses will transact. 80% of people who would like to sell a business don't find a buyer. Sometimes I can step into a business for very cheap. This is what we're talking about. This is actually my 5th book. It's coming out. It's going to be about how to buy a business, how to do the research, how to find them, how to pay for them, all that kind of good stuff. But that's an alternate potential reality from what a lot of your listeners might be used to thinking.
Yep. No, that's great. Do you think, what are some of the industries that you're most excited about right now? Because I have a story that it seems like this space is now overcrowded because of the U's of the world, the Cody Sanchez's of the world, telling everyone, get in there and buy old businesses, and there's so many, anyone can do it. And now it just feels like at least a noisy space of everyone's trying to do this, and there's so many groups being formed to buy these old, boring businesses.
I work with 71 founder-led companies, and I'll tell you, I work with 9 roofing companies right now. So roofing companies are a space that private equity has a lot of interest in right now. It is project-based, but again, huge numbers being made by people who are putting together roofing companies. HVAC, is another place where it's kind of oversaturated, but there's a lot of activity there. Again, predominantly project-based type companies. But if I think of professional services, so professional services has all those things I'm talking about, needs versus wants, recurrent contracted revenue versus project based. But another feature of professional services, they tend to have very low capital expenditures and very high free cash flow generation. So I'm working on 3 roll-ups in the accounting space. Accounting is another area where PE is loving and chomping at the bit to come in. But because there's 1.8 million small firms and there's not a lot of bigger ones, there's nothing for them to buy, kind of at that $4 million to $10 million EBITDA level. And so there's a lot of entrepreneurial effort to create some roll-ups in that space. And, multiples being paid are relatively low. Free cash flow generation is really high. It's not uncommon to find a company with 3 million in revenue that has $1 million plus in earnings and is selling for 3.5 times, and so low purchase price, high cash flow, and so that's an industry that people are doing a lot of work on. Pest control is another place, landscape maintenance, these are not sexy companies again, but multi-billion-dollar companies have been built in pest control, in landscape maintenance, and there's still a ton of efforts around doing more of it. Property management on the, for those real estate investors out there, I'm seeing a lot of activity in the property management space. For you tech people, MSPs, managed services providers, ton of activity. I have a couple of exits, over 400 million in exits for a couple of entrepreneur clients of mine in that specific industry, and I'm working with multiple in that space right now. So managed services providers, another great area where high fragmentation, bunch of small companies, people who are aggregating in that industry are doing really well on exits. So it's the blue collar services, the blue collar trades, home services, a lot of activity in home service type companies. A lot of activity in professional services. I do work with manufacturers too, and people who have product-based businesses. They're not my favorite area to play because they generally have higher capital expenditure. If you have a plant with equipment, or a high cost to produce a widget or a product sales, if they're not needs again versus wants, then if I'm making dog food, and dogs need to eat regardless of the economy, and so if I'm making dog food as an example, you see a lot of these little boutiques, and I'm working with a couple well-known people in that particular space to put together a nationwide chain of kennels, and pet services type companies. A lot of roll-ups in veterinarian space. I'm working on multiple roll-ups in dental, so working with dentists who are buying other dental practices and building them. Again, these are places where there's been billion-dollar exits already in private equity. So ton of activity, and it really follows the framework: needs versus wants, services versus product, and low capital expenditure, high free cash flow, low multiples because there's high fragmentation, good multiple expansion as I create something that's rare by building it up. These are the types of themes that you're hearing a lot of. And, Cody's a good example. I've heard some of her stuff. It's like, it's Main Street versus Wall Street. It's like, these are businesses that are just historically not sexy, but my word, there's just a ton of money to be made for entrepreneurs in these areas. If you have the skill set, if you're not reckless, if you're very disciplined when you're buying a business. And what I usually tell people is to do research on an industry first. I subscribe to databases where I can look at private company transactions. I can see what companies are selling for, what the multiple of revenue, the multiple of earnings, what prices are being paid. I can look at arbitrage between what small companies are sold for versus large companies. I can do basic research around fragmentation in an industry. How big is an addressable market, and how many players are there in the market? And all of that kind of research really helps inform my thinking. And then creating an avatar, I call it, or understanding what's known as the buy box. What am I looking for? What is the perfect acquisition? What's the revenue size? What is the earnings size? What kind of customer verticals are they servicing? And what are the prices that are being paid? So what am I willing to pay? Because sometimes I'll find a great company, but the seller has an unrealistic expectation on what they want in terms of price. And so I'm a disciplined buyer. I don't pay more than market, and I want to buy good companies. One of the biggest mistakes I see people make too is we don't want to buy fixer uppers. It's hard enough to buy good companies, get your deals done, and build. And so I'm not looking for an opportunity. I'm looking to buy a good company that was built by a good person that has a good reputation in a marketplace. And I'm willing to pay fair market value for that because I know as I grow it, I'm going to get multiple expansion and arbitrage as it gets bigger. And I'm going to earn mine. My money is going to be there. So I don't buy fixer uppers. I only buy good companies built and run by good people. That's the ideal scenario. And by building that buy box and having an avatar of what I'm looking for, it helps me when I'm looking under the hood of a bunch of companies to know when to move on and when to dig in. Boy, I could talk about this stuff for days.
No, I can tell. I love it. I can tell that you teach this for sure. I want to shift into generational wealth. I want to hear your thoughts on this because I know it's something you've talked about before. And I want to hear what are some misconceptions around it? What do you wish that more people understood when thinking about whether it be starting a business, growing one, buying them, and then thinking about the long-term outcome of that?
So I'll go back to my pilot, from the beginning. I talked about, pilots don't take off unless we know where we're going. I think if we're an entrepreneur building a business, we need a destination. We need to, maybe we monetize it, maybe we don't. I write articles for Forbes every month. Last year, I wrote an article called When's the Time to Sell My Business? And I created this rule called the Rule of 130. So I take my age, I'm 60. So I write down 60. And then I add to it, what percent of my net worth is tied up in this illiquid thing known as my company? And most of the entrepreneurs that I work with are in their 40s or 50s or 60s. And they have a really high disproportionate amount of their net worth tied up in their business. And as they're getting older, they're just assuming way too much risk. And I hate to see entrepreneurs out there taking on too much risk. And so, I want people to be very mindful about if you run a business today, if you're building a business today, what are you building it for? Where are you headed to? And at what point are you going to monetize it? And we joked a little bit about Mark Zuckerberg, and there's a lot of people out there who think, boy, if I'm not the sole shareholder or the controlling shareholder, there's no way, I'm going to stay inside a company. And that's a pretty arrogant way of thinking, and I call it the accidental arrogance of success. And usually when people think about, geez, why would I stay in a business I'm selling? Most entrepreneurs think of exiting a business as a one and done event. I like to call it's the first rest stop on the wealth creation highway. So I want people to get in a mindset that says, I'm going to build a business to a certain size, and then I'm going to cash out my chips. And I'm going to take a big chunk of money off the table, invest it elsewhere, and let that become my asset diversification. And then instead of walking away and thinking, okay, what's next? What's my next great idea that I have to beat the odds on? Stay in the business you're already building that you already know, become a rollover investor alongside an institutional shareholder like a private equity firm, and build it, keep building it, but now using their capital instead of your capital, and accelerate the pace of growth, and then sell it again and again and again. And my personal record is selling the same company 5 times in 13 years. You want to generate true wealth for your family, at some point you have to monetize the asset. And if I sit with an entrepreneur and I say, what size revenue are you and earnings are you today? And I build a spreadsheet, and we roll tape forward 5 years, how big would you be? How much would your earnings be? What would the company be worth? Roll tape forward 10 years. What would the size be? And other than a tech startup that's got no revenue, goes from $1 revenue to $2 and says, I've got 100% growth. I'm talking about companies that have been around for a while that have, a history of growth, in revenue and earnings. Most of them are growing at a fairly slow pace that wouldn't excite investors to just do it organically. Then let's look at selling that business today at its current size, rolling 30% forward to reinvest alongside your new majority shareholder, a PE firm. And now we're going to buy a bunch of companies, put it together. How big will we be in 5 years? We've gotten bigger. We've gotten multiple expansion, and now what does that company sell for? Take 70 cents home on a dollar, roll 30 cents forward. And now we buy a bunch more companies and we do it again. And I got 3 paydays in a 10-year period on average. And when I add up those 3 paydays, never in my entire life have I created a spreadsheet where an entrepreneur makes more money by staying alone, staying independent versus selling, joining a buy and build, and becoming a CEO of a portfolio company, that's backed by private equity. It just doesn't happen. And a lot of people are nervous about that. We fear the unknown. Well, I hear the horror stories about private equity and how they destroy companies. And yeah, okay, I hear those horror stories too. That's why I wrote the private equity playbook. The private equity that I've worked with for 20 years isn't what I hear about on the news either. The news tells me everything sucks and everything that's miserable. They don't tell me the good things. The last company I built, I was owned by Ares Management, the world's largest non-bank lender, one of the world's largest PE firms. What you didn't hear in the news was when COVID hit, inside every company that they owned, they started a foundation, a charity, and they seeded it with 6-figure sums of money in all their companies and said, CEOs of Ares-owned companies, please take care of your employees. Those impacted by COVID, those who have an unfortunate illness or extended absence from work, or heaven forbid, there was a death in the family, let's help. We didn't hear about that side of private equity in the news. There's actually good firms out there who care about people, who care about cultures. And for those of you who are afraid to be a minority shareholder in your own company, I usually talk about, Elon Musk and Jeff Bezos. The 2 richest people on the planet own less than 13% of their respective companies. You can actually be a minority shareholder and make a ton of money, and you can get multiple bites of the apple at your company rather than just one. Bad things do happen in the world. And I'll give you just one example. A company I work with in the UK is in the machining industry. So 5-axis CNC milling. Their largest client was in Russia. And, about 40% of their revenue was one client in Russia. They weren't making weapons, but when the war with Ukraine hit, the British government stopped all exports to Russia. And my client lost 40% of his revenue, overnight, and scrambled to survive, and then hired me to help him as a consultant survive. And we survived, and we're now rebuilding, but the war's still going on. And so his revenue was still interrupted, and I can tell you horror stories of people who were in their 70s trying to sell their business, and they wanted too much money. And they didn't take fair market value, and then COVID hit. And when COVID hit, we learned about essential businesses versus non-essential business. And unfortunately, I have too many examples of people who were non-essential, or they were essential, but their client base was non-essential, and value was destroyed forever, in that environment. Even though the economy more or less recovered, people now can look at revenue and say, geez, you had so much risk during COVID. What have you done to change your revenue profile as a company? And if the answer is nothing, then your value is still low. It's destroyed, because of this thing that was known as COVID. So wars happen, planes fly into buildings, pandemics happen, economies, the Great Recession. It's like bad things can happen. And I see entrepreneurs taking too much risk. And I want entrepreneurs to think about building wealth and securing your family's future. And when I've got all my eggs in that company basket, I've got a ton of risk. And so as I get older, unfortunately, I'm cognizant of that risk. And so now I start making bad investment decisions. I stop investing in growth. The growth of my company slows down. I'm in maintenance mode. Then I go to sell it, and I haven't grown in the last 3 years. And the buyers are like, it's not a growth company. I'm not paying maximum value for it. Where I could sell it, bring in a capital partner, use their money, take some chips off the table, and aggressively continue to grow my business and build something where the second bite of the apple is actually bigger than the first, or the third's bigger than the second. And so, I care about people and the wealth that they're building. And I really think that we need to be not so cavalier as we're building a business, we should exit. And my rule of thumb is I want you to exit at either about 4 to 5 million of EBITDA, or when you hit 10, at least for the first time, and to not spend, too many years trying to swing for, call it the 10-figure exit, when you've got 9 figures of value in this business, and you should monetize that and get that asset diversification. I like to see entrepreneurs taking advantage of this thing called private equity, and learning how to monetize their asset and get chips off the table rather than having too much risk.
Yeah, so good. Such a different way of thinking. We definitely could go on and on for this. Maybe that's why we need a round 2 interview in the future, because I do want to have one last question talking about 2025 with Trump being in office now. It seems like a very different world, very business friendly, I would say. Also, what do you see coming for 2025 for entrepreneurs or people looking to buy businesses?
I would say just in general, regardless of who's in power, over the last several years, what we've seen is a lot of market volatility, a lot of up, a lot of down, but the general trend has been up. So Trump wins the election. Business owners, business community seems to have really liked that and been satisfied with that. Market immediately went up 1,500 points the next day, and it's sustained it. It has sustained a new level. Interest rates last year, we lost, 50 basis points, 75 basis points. We're expecting another quarter point, through the end of the year, the first quarter of next year. So the high interest rate environment starting to moderate. And there's over $1 trillion. I've seen estimates as high as about 1.9 trillion in assets under management, committed capital in the world of private equity that is in powder, looking for stuff to buy, stuff to invest in. I'm bullish on 2025 and 2026 and kind of the next 3-4 years, that I think there will be a lot of investment made. If Trump does everything that he says he will, which I have no reason to doubt that then oil is going to come down in price. We're going to be drilling. The price of gasoline will come down. That will stimulate a lot of activity, economic activity. I know there's a lot of news in the press about these tariffs. I'll tell you that Trump is not seeking to use tariffs to generate revenue. He's seeking to use it as a lever to drive a fairer playing field for American exports. And my anticipation, again, is further economic growth, expansion. I'm pretty bullish. And a lot of people would have told you that regardless of who was in office, that they were pretty bullish on 2025. But I think with Trump's victory, now even more so, you've got a lot of focus on trying to stimulate U.S. exports, trying to stimulate the U.S. economy, trying to reduce some of the base costs for things like oil, gasoline, food, what have you. So I'm expecting a period of expansion and some great investing going on over the next 2 to 3 years. A lot of capital out there, and so for many entrepreneurs, they struggle with capital and they think capital is my problem. If I only had money, there's a ton of money out there. You just need to learn where it's at and how to treat it, and you'll get your fair share. And so I'm very bullish on the next few years. We do have some wars going on out there. We've got a war in the Middle East, a war in Europe. So I'm hopeful that we can wind these two down, because war is kind of one of the biggest instabilities, that are out there. But if you can calm down what's going on, once Trump's in office, boy, he was just in Paris for the opening of Notre Dame, and you saw how the rest of the world was treating him. He's the anointed one, and there wasn't the hatred and fear that we were being pumped with. He seems to be kind of settling back in. He's going to be a disruptor in terms of the government for sure. There's no question of that. But I think all in all, economy is going to be strong. A lot of room. Look at what happened to Bitcoin. And cryptos. Just in the last month or so. So I'm very bullish. I think we have good times ahead. Always risk. It's volatile, remains volatile out there. But all of my wealth management people and the people that I'm around on Wall Street, it's like it'll be a volatile market, but it's going to be a volatile market that's climbing. And when the market drops 1,000 points, there's your investment time. And when it's back up, then it's like it's going to be the bias will be positive. The bias is towards growth.
Yeah, I love that. And I love the optimism. I share that as well. Well, Adam, thanks for coming on the show today. Where can our listeners, our viewers find out more about you and your upcoming book that's going to be released in a couple months?
Social media is the easiest place to connect with me. I mean, there's adamcoffee.com. There's the chairmangroup.us is my company, but LinkedIn, I'm on Instagram. I'm also on X, but the reality is I spend most of my time on LinkedIn. Why am I on LinkedIn? Because there's 830 million business people on LinkedIn. And most of my clients, I'd say that's my wheelhouse. That's my world. And so here's an interesting tidbit is I don't have someone in my social media accounts. When you reach out to me on LinkedIn, you get me, every day I'm up at 4 o'clock in the morning and I'm literally responding to hundreds of people who are reaching out. And,
Mm-hmm.
and of course, everybody asks for time on my calendar, which I couldn't possibly do, and then
Yeah.
there's, the 30 million people who want to sell me things. But aside from that, it's like people who generally reach out to me, they get
Yeah.
me. And so I,
Yep.
I love hearing from people who hear me on podcasts or read my books. Happy to be a resource for all. That was my goal and objective. I'm 60. At 70, I'm calling it quits. I joked before this started, I work for jet fuel. I'm working and trying to help entrepreneurs beat the odds and succeed. And that's what I've dedicated the last 10 years of my career toward. So I look forward to hearing from everybody who's
Love
out
it.
there who's listening to this.
Amazing. Thanks so much, Adam.
Thank you for having me.